Going on, everybody? Good morning and welcome back to Beat the Bell, presented by King Capital. So, things are getting interesting in the market. Last week, of course, extremely volatile. To start this week, we are getting some weak price action in the S&P futures. Is a really important trend line that a lot of people are watching that we'll be covering just in a bit. But bulls certainly dropped the ball on the opportunity to hold and make a October bottom right when they needed to. But in checking the SP futures this morning, it looks like we did make a new low below that previous October low, which doesn't look good for bulls. So we'll be talking about that later on in the show. Money Mander, good morning.
Good morning. Happy Monday, everyone. Bears in total control, and we'll talk about why in just a second here.
All right, Diamond Trades, good morning.
Good morning. Hope everybody had a great weekend. Big week. Got a lot to cover.
All right, Fed forecast and economic calendar.
Yeah, let's do it. We'll start with the economic calendar. So the economic calendar is pretty light to start the week. Chicago Fed National Activity Index, which just came out. And then tomorrow we've got composite flash PMI as well as the Richmond Manufacturing Index before new home sales on Wednesday. The biggest news drivers of the week as far as the economic calendar will definitely be towards the end of the week with durable goods on Thursday, as well as the GDP growth rate for Q3. It's going to be an advanced print, so that won't be the final number. We'll get the final number, I believe, in November at some point. And then to round out the week, we'll get core PCE. That's what the Fed prefers to watch regarding inflation as well. I have a typo in there. That's terrible. And then Michigan consumer sentiment on Friday as well. So the economic data is stacked towards the end of the week. Big week for earnings as well. We've got some of the bigger names reporting this week: Coca-Cola, Google, Microsoft, Snapchat, all reporting on Tuesday. We've got Boeing before market open on Wednesday, as well as Meta after the close on Wednesday. Thursday, Amazon, Ford, and UPS before Exxon and Chevron on Friday. Chevron actually just bought Hess. I believe that the news of that deal just came out either today or yesterday. So it'll be interesting to see what they've got in their earnings. We'll cover that a little bit more as we go on. But let's first talk about last week's trading, as Alejandro mentioned. We did get some weakness in the market last week in the face of stronger economic data and lackluster earnings from some market heavyweights and escalating tensions in the Middle East. The NASDAQ led declines, falling 2.93%, with the S&P losing 2.39% and the Dow dropping 1.63% to put it back into negative territory year to date. Yields continue to push higher, with the benchmark 10-year almost tapping 5% intra-week. I believe that in the overnight trading here we actually did get up to that 5% on the 10-year, which is obviously a key number. We haven't been in this realm really since 2007. Every single time that we set a new high, you're going to hear highest since 2007. That's at least until we get up above like the 5.3. So just be prepared for that. What else did we have last week? The dollar actually held pretty flat last week, lost about 0.5%. The S&P 500 is now down about 8% off of its highs set back in the summer, making this correction almost equally as bad as the March pullback that was sparked by fears of widespread bank failures. SPY is just a few dollars off of its 200-day moving average, a common indicator used to determine directional trend in the market. Should the market fail to hold the 200-day moving average as support, it could indicate a short to intermediate turn trend flip that would jeopardize the index's year-to-date gains into the end of Q4. With the market pulling back in recent weeks, much of the talk has been focused around the names that have kept us afloat. The Magnificent Seven, as people like to call them, a group of particularly strong stocks that have carried much of the market's advances this year. Those Magnificent Seven would be Google, Amazon, Apple, Microsoft, NVIDIA, Tesla, and Meta. These stocks have buoyed the indices with their strong performance, while more or less every other stock in the market has struggled so far this year. According to S&P Dow Jones, without these 7 stocks, the S&P 500's year-to-date gains would be just 0.6% this year versus the current 11% year-to-date gain that we're sitting at. So we have more or less all of this year's gains to really attribute to those 7 stocks. This group will be tested this week as Amazon, Google, Meta, and Microsoft deliver Q3 earnings. Many will be looking to see if the numbers match the premium that these companies have traded at over the last 10 months. If you look around the market, a lot of the other high flyers have really taken a hit. And while you have seen pullbacks, amongst more or less all of these names, are still massively outperforming the index year to date. Investors will be watching keenly to see what impact, if any, the challenging macro environment has had on these companies' ability to continue to grow their top and bottom lines amidst tighter financial conditions. The growth rates that these companies deliver is incredibly important to the perception of the health of the overall equity market. That's from Bryant. That's from a senior portfolio manager over at Allspring Global Investments. The Magnificent Seven stocks account for 30% of the S&P's 500 market value, which is up from just 22% last year. The market has already shown a willingness to punish lackluster earnings, even amongst this group of tech darlings, with Tesla dropping 9% last week on weak numbers. So, Sal, what are you looking at this week as far as earnings and price action here as we end October?
Yeah, I think going into earnings specifically, we were kind of interested to see going into this round of earnings what the sentiment was going to be, because we had seen 2 sessions ago on earnings reports, companies that weren't reporting great numbers were not getting punished as much, but the ones that had good reports then rallied and kind of led the rest of the index with them. And then going back to last earnings season, we had pretty much the dead opposite. Companies that had poor earnings got really punished, but then ones that had good earnings really didn't get the trade higher. They just maintained gains they had already made. And so going into Tesla's numbers with the double miss last week, I think, and Netflix in comparison, I think we might have something where, just depending on where these stocks are trading at, you could really see both, which would lead to more of a flatter reaction across the indices than what we've been used to in the past 2 cycles, because Tesla on the double miss closed down 13.3% into the end of the week on what Dan Ives, if I know a lot of people follow here, and his team of analysts at Wedbush, said in a nutshell, we would characterize last night's conference call as a mini disaster, he said on Thursday. But then going into Netflix, on the other hand, this leapt up 16% after reporting they added 8.8 million new net paid subscribers last quarter. So I think, we'll see what we get with the megas here, but I think we could be in a situation where stocks could actually trade for once based on less sentiment, but more their actual reports. We'll see what we get this week with a lot of the big ones reporting. And then the big driver last week, I think, really was Powell, which we didn't know if his conference and his speech was going to be much of a mover, but ultimately dropped 0.8% on the day of his speech, with 10 of the 11 sectors finishing red, which then led really into the Friday continuation to the downside on OPEX. He initially suggested central banks were unlikely to raise interest rates, which gave us that initial pop. Got interrupted by climate activists, and then coming straight back from the interruption, said, given the uncertainties and risks and how far we've come, the committee is proceeding carefully, saying the bevy of data showed labor market tightness and price pressures are easing. But given the Fed's room to stand pat, he said the central bank would be willing to raise rates further if strong economic activity sparked more worries. And so I think he really hasn't changed sentiment whatsoever. And so when data is going to come in hot and stronger economically than expected, we're going to see sell-offs. And that's really where we've been at. The 10-year, to your point, did hit over 5% this morning. It's looking like it's going to open the session of the stock market under 5, but still, obviously, we're getting full higher for longer sentiment getting priced in. And so if earnings really come in poorly than expected across a lot of these megas that you mentioned, make up the majority of the market cap that has really led to the upside here, I think along with all the outside drivers we have for downside, it could get a really ugly end to October here.
I think for Jerome Powell, he is kind of in a decent situation here where it seems like I feel like the problem early in the year, and we harped on this a lot on Fed forecast, was how the markets weren't really respecting what he was saying, right? We had tech just absolutely ripping, yields weren't really moving, and he was sort of forecasting hey, look, here's our plan, going to the end of the year, and the market was sort of just you guys will capitulate like you always do, you guys will change course, right? And it seems like at this point markets are finally starting to sort of price in his idea of what the next year will look like. And so it seems like he really doesn't have much to do, right? You've already seen longer term yields rally, which is obviously tightened financial conditions for him. And I think that particularly with the eruption of tensions in the Middle East, it puts him in a situation where, him and other Fed members can sort of sit back and wait, like he always says, for the data to come in and see what it looks like. This finally seems like a situation where they're sort of in control and they can, make the next move, as opposed to sort of, having to fight the markets basically on every time that they give an anticipation for what they're going to do going forward. So it seems like, at least for him, he's in a better spot. The Fed is in a better spot than they were. You look back 6-7 months ago, where markets really just were not listening to what he was saying. So I don't know. That's sort of at least how I feel after his talk last week.
Yeah, I think whether it be Fed talk or not, we kind of said this going right after the September meeting. Markets are doing exactly what he wanted to. And so whether they do end up holding higher for longer like they projected, or whether they did that more so to tighten the longer duration of the yield curve, I think markets are reacting exactly how he wanted them to moving forward. So we'll see what we get the rest of the week, the end of October. But I think it's all going to be down to earnings at this point.
Right. That will wrap it up for Fed forecast. We'll pass it back to Alejandro. Is he here?
Alejandro's not here.
Holy Ryan.
Hey, what's up, guys? I'm the producer of the show. Alejandro's in the bathroom. He just texted all of us and said that he asked to go to the bathroom so badly that he can't do ES futures or bet the bell. But you know what? I can do bet the bell, right?
You want to do bet the bell?
Yeah, I'll do bet the bell. Because you guys were just talking for how long? So let's take a look at the stats.
That's actually the funniest thing ever.
I mean, we're running on the fly here, man. This is my first rodeo, so I'm no snipes. But let's start things off with the traditional green or red diamond.
Yeah, let me take it. I will go green. I'll go green to start the week.
This is a tough one. I think I'm also going to stick green. Futures trading a little bit down in pre-market here, but getting a rally off of the lows. And I think that the real sentiment recently has been gap up or trade higher on Mondays for a continued downside move into the end of the week. So I'm going to stick with that. Take green for the day.
Perfect, Mander. Thank you for a longer answer so we can kill some time here. Noah did not appreciate the clip. All right, we're moving on to our next question. I've been curious. Is it too late for us to buy gold? Diamond, going with you.
Yeah, let me take this one. So the reason that we even did this question on the slate is because Mander actually texted me last week and asked me if it's too late for him to buy gold. It's interesting. You have obviously the rally since the sort of breakout of tensions in the Middle East. What are we up like a good 7% since then? So I mean, gold is one of those things that's tough because it only really moves when you get these, like it's a catalyst mover, right? Like if there's no catalyst, it sort of just sits there and does nothing. And even looking like taking a sort of 10,000 foot view, like you look at like a weekly chart or a monthly chart, we're still sort of in this like 2,200 to like 1,800 range that we've been in for the last like 2 years. So, I mean, I think it's too late to buy gold? No. Do I think that you're going to get like some crazy run on the highs that we haven't seen, since really like COVID? I think that it would probably take an increase in geopolitical tensions for something like that to happen. So look, I don't think it's too late to buy gold. I feel like gold is one of those things that you buy it as sort of like a hedge for the markets and you buy it and don't look at it, right? I don't think that you would buy this looking for, some sort of short-term move, some sort of short-term rally, because I think that those are hard to predict everywhere in the market, but particularly in an asset like gold that sort of just trades sideways most of the time unless there's some unexpected news. So that will be my answer.
Yeah, to your exact point, and we'll say not financial advice for this one, but I think exactly to your point, gold should be looked at as a hedge for markets. So I think especially for people with no exposure outside of equities, it's really not too late to buy gold whatsoever. But looking at the chart even, we're trading exactly in that range you spoke of, really between like 1,700 and 2,150, you can call it, on the double top we had going back on a weekly. So I think realistically with the breakout we're seeing here, you feel like you're chasing a move to the upside, but if you got long risking that double bottom low, looking for a breakout above this double top here in the range we've been trading in, I don't think it's too late whatsoever. And it'll feel too late if you did not buy any gold to hedge equities and this continues to blow out through that double top as the markets start to roll over. So I think in this instance, some exposure for a hedge is better than thinking you're chasing something on the breakout here.
Perfect. Alejandro, are we too late to buy gold?
What's going on, Ryan? I don't know much about gold, but I'd much rather talk about your first ever appearance on the show. Congratulations. Never thought
I was thrown to the fire here, man. I'm just trying to get the show moving along.
You're doing a great job. I actually saw our viewer count start to tick up as soon as you popped up on screen. So maybe we should have you on more often.
The fans love me, man. What can I say? You're just gonna skip the gold question. That's fine. I was reading my favorite market publication, the front page of Marketwatch.com today, and this is what it said. Morgan Stanley's Wilson said, next rally attempt will fail as investors are punishing earnings reports. What do we think about this next rally? Is it going to fail? Do we want to start with maybe Money Mander? How do we feel?
Yeah, I think if this came from anyone besides Morgan Stanley's Wilson, we'd probably take this with some more seriousness. But he's been harping on short the top pretty much for all year and been getting cooked. So from him, I wouldn't say so. But I think going into this week, like we mentioned on Fed Forecast, it's going to be really interesting to see if companies are rewarded for good earnings or if they get more of a Tesla move and a slight double miss then sends them down 13% like we saw in Tesla. Obviously, I think that was more of a technical setup on a breakout to the downside than anything. But with a lot of them reporting this week, it'll be interesting to see if investors look at upside beats as exit liquidity to take profits or if people are still eager to get in and buy new longs. That'll be the big thing to watch at the end of the month.
I think that like more directly to Mander's question, like will pops sort of be sold? Like if Amazon, for example, was to come in with like a double B, or even Netflix's move last week, like does that move sort of get reversed? And Netflix isn't one of the Magnificent Seven, but you know it is one of the larger tech stocks in the market. I mean, the way that I look at it is like if those are really the only stocks that have yet to take that sort of hit, and they've been really carrying the market thus far. So it's like if it isn't broke, don't fix it kind of deal. Like I don't know if you know, a pop after earnings in Apple or Amazon for me would be like a sell. I think it's more of like a buy the dip, and not necessarily like, you know, if Apple drops in earnings, I'm buying it to see that rally into the end of the year. But it's more so like long term. I want to own Apple. I want to own Amazon. Like those are names that I want to own. And so, I mean, one earnings call isn't necessarily going to be the end of the world. I think I saw from Tom Lee, FundStrat's Tom Lee, last week after the Tesla numbers that like the 9% drop was like only the 30th worst reaction that they've had to earnings, or like something like that, like top 20. So it's like, yeah, is it bad? Yes. You know, does it feel good to be in Tesla as, you know, it dumps 13% on the week? No. But if you're somebody who's, you know, buying the long-term vision, it really shouldn't be like a massive sticking point for you. And if you're somebody who doesn't own as much as you would like to, then I guess you can use those as buying opportunities. And so that's what I plan to do in a lot of these names.
So when was this article published? That's my first question. Is that this morning?
That was this morning at 7 a.m.
Okay. All right. That's interesting because to me, the rally has already failed. So I'm guessing this publication is more talking about, you know, a possible like late November, December rally that we typically see. But this weakness that we're getting, all right, so obviously Tesla earnings last week, really ugly. The stock plummeted. This rally that we started to get at the start of October, I talked about how I wanted to see that rally really sustain. And bulls, this has been the time. This is the time that bulls really need to step in. And this weakness in October is the first time all year, literally all year, that we have not tracked well with seasonality. And I think that this is actually concerning. This is the first time I've been, you know, looking at the charts, thinking about how the market is trading, and asking myself, are we in for maybe a weaker close to the year than originally anticipated? I mean, the dip in September, while ugly, was exactly what was supposed to happen. The dip in August, while ugly, was exactly what was supposed to happen. Now, bulls are supposed to step in October, and we slowly start to climb up through the remainder of the year. But this weakness and this creation of a new October low is no bueno. And so I think that, we'll talk about it to close up the show, but there's a really important trend line that we're watching. And I think anything below that trend line, that the rallies are going to fail. So that'll make more sense in a few minutes.
We're still doing ES futures. We're doing your charts.
Yeah, quickly, because I think it's important.
Sick. Okay, didn't know that. Do we want to do this one about earnings? Why not?
Yeah, we're good.
Hondo.
What? No, let's go to Hondo. Perfect.
All right.
Hondo, take it away.
All right.
Go ahead and share your screen.
Thanks, boss. All right, so this is the trend line we've been talking about. Everybody's been talking about this trend line. I've seen a few people post it on Twitter, but it really is important. So this is the low going back to October of 2022. All right, and connected with the March low. So this is basically sustained the entire bull market. Now, in early October, what we got was a false breakdown below this level. When we reclaimed, we got a really nice rally. And I said, as long as we continue to trade above this trend line, it should be smooth sailing into the end of the year. We've now lost that trend line and remade a new low. So the way this works, of course, is in order for bulls to regain control, they're going to need to reclaim this trend line, which is a rising trend line. So anything below here, again, I think that we could see some weakness. So very important to monitor. I think that this is a big change in structure shift for the overall market. Again, we haven't seen this type of breakdown all year long. The only other significant breakdown was this. Let me see if I can do this quickly. If we took the March lows and we just drew this trend line up that had sustained the bull market. Okay, so that was the only other really major breakdown that we got. So not looking good for bulls, guys. I'll be honest, but hopefully we get to reclaim this trend line. Hopefully we reclaim this trend line, and that would put us in a good spot to close the year. That's that. Really, the only thing you need to be focusing on, big picture. There's a lot of noise out there currently. Obviously, we have the tensions in the Middle East, earnings. Oh man, it's just a crazy time to be trading, crazy time to be an investor. Just focus on what's important for you. Block out as much noise as possible. That's up to you what you decide or the information that you decide to let impact your trading and your investing. Always remember that. It's your choice. All right. So that's going to do it for this morning's show. Appreciate everybody who tuned in. We'll be trading live in the King Capital Discord. You guys can go to king-capital.com or scan the QR code on the screen. Let's have a great week, everybody. Hopefully you guys are fired up and ready to go. We'll see you back here on Wednesday morning at 8:30 a.m. Eastern Time.